After a strong rally this month, Bitcoin just dipped to 115K, and as expected, altcoins took an even harder hit with sharp corrections across the board. This pullback has reignited the conversation around whether we're nearing a cycle top. Most people still don't think the top is in yet, but it's always smart to stay aware of where we are in the cycle and prepare for every scenario. In today's video, we'll dive into some of the most widely followed top indicators to see what they're signaling about the current stage of this bull run. I'll also share my honest take on whether each indicator still holds weight or if it's losing relevance due to how different this Bitcoin cycle has been so far. On top of that, we'll break down Bitcoin's current price action and map out what could come next for both Bitcoin and altcoins. If that sounds valuable, hit that like button to support the channel. It really helps me keep bringing you grounded, no-hype content. And if you're new here, make sure to subscribe so you don't miss what's coming next. Let's jump straight in. Let's first take a quick look at the market before diving into the indicators. Bitcoin recently faced a pretty strong rejection after trying to push higher, with price getting knocked back just before reaching the all-time high zone. Right now, it's pulling back towards the CME gap area around 114,300. Today's candle has printed quite a long lower wick, which suggests that buyers stepped in to defend this level, at least for now. But overall, momentum does seem to be slowing down compared to the strong impulsive rally we saw earlier this month. This CME gap is acting as an initial support region, and it'll be crucial to see if Bitcoin can keep closing daily candles above it. If we do get a clean bounce here and price manages to reclaim the previous consolidation range, then there's a good chance it will make another attempt to push towards the all-time high area around 123,000. On the other hand, if this CME gap doesn't hold and Bitcoin starts closing daily candles below it, we could see a deeper pullback. The next key supports are around 112K and further down near 109K. Both these levels line up with previous consolidations and breakout zones, which means buyers could look to step back in there. Lastly, there's major support sitting down at 106K, a level that has been respected multiple times in the past and would likely act as a strong demand zone if tested again. Overall, the structure still looks bullish on the higher timeframes, but there are clear signs of exhaustion creeping in on the short-term charts. The market has rallied pretty aggressively from those June lows, so seeing some cooling off or even a deeper retracement here wouldn't really be a surprise before Bitcoin gears up for another attempt at all-time highs. For now, it makes sense to just wait and see how price reacts around this CME gap region. If buyers manage to keep defending this area, we could get a swift move back up towards the highs. But if this support breaks and we start seeing daily closes below it, the chances of a bigger correction go up. Price could then drop into the sub-110K zones before starting the next move higher. Looking at Bitcoin dominance, it has seen a pretty sharp drop over the past 2 weeks, falling from above 66% down to nearly 60%. That's a significant move, especially considering how strong the uptrend had been since the start of the year. On one hand, this decline is opening up some space for altcoins to breathe, since falling dominance often signals that market participants are ready to take on more risk and rotate into alts. However, it's worth remembering that BTC dominance is still holding above that key 60% level, which has historically acted as strong support. If dominance does continue to slide below 60%, it could really set the stage for a broader alt season with strong rotations into mid and low caps. But if dominance finds support here and starts bouncing back up, Bitcoin could quickly reclaim market leadership and stall out altcoin momentum once again. Another big reason behind this recent drop in Bitcoin dominance is ETH's strong rally. ETH has been showing impressive strength against Bitcoin lately, with the Eath-BTC pair finally breaking above that crucial 0.30 resistance we've been tracking for weeks. Right now, it's consolidating just above 0.32, which is a healthy sign after such a strong move up. This breakout is important because it marks a clear shift in market structure, suggesting ETH is stepping up to lead the next leg higher for altcoins. If it can continue holding above 0.30 and keep building higher lows from here, the next major target to watch sits around 0.36. That zone has acted as a strong resistance on higher timeframes, and reaching it would signal growing confidence across the altcoin market. Historically, when Eath-BTC gains momentum like this, it often kicks off the early phases of Altseason where ETH outperforms Bitcoin and drags the rest of the market up with it. Overall, as long as Eath-BTC maintains above 0.30, the bias remains bullish for altcoins. Any clean push towards that upper resistance could trigger aggressive rotations into smaller caps as traders chase higher beta plays. Keep a close eye on this pair, because it continues to act as a reliable driver of risk appetite across the crypto space. Alright, now let's zoom out a bit and get a sense of where we are in the bigger picture of this cycle, and more importantly, how high this bull market could actually go. We're going to look at a few of the popular indicators that traders use to predict cycle tops and see what they're signaling right now. First up is the Pi cycle indicator. This tool uses two moving averages, the 111-day moving average to track short-term trends, and the 350-day moving average multiplied by 2 to track longer-term trends. The ratio between these averages comes close to the mathematical value of pi, which is why it's named the Pi cycle indicator. Historically, whenever the 111-day MA crosses above the 350-day MA, a major cycle peak has formed within just a few days. There's also another version of this indicator that extends its projections based on the same mechanics. As always, I'll link all these charts down in the description for you to check out later. Currently, if we project along its existing trajectory, it forecasts a potential cycle peak somewhere around October 2026 with Bitcoin price near the 400K mark. In my view, this indicator will probably fail to nail the exact top this time. Even though it has been accurate in past cycles, the reality is that for a crossover to happen here, Bitcoin would need to rally aggressively for months on end without significant corrections. Given current market structures and macro conditions, that kind of sustained vertical move seems unlikely in this cycle. Although I'd be happy to be wrong and rich. That said, even if it doesn't perfectly call the top, the Pi cycle remains a useful tool for risk management to gauge when we are entering overheated zones and position accordingly. Another useful indicator is the MVRV-Z score. This tool uses blockchain data to measure when Bitcoin is extremely overvalued or undervalued relative to its fair value. Right now, the score is sitting at 2.6, which is quite low compared to earlier rallies this cycle. For context, during the March rally it reached 2.9, and in December it peaked at 3.3. If you look back at previous cycles, the score crossed above 8 multiple times. In 2017, the peak was 9.7, while in 2021 it topped at 6.9. However, there's a clear trend of diminishing returns each cycle. Waiting for extreme readings like past peaks to offload bags could leave you trapped. A smarter approach is to start scaling out once we enter the 3.5 to 4 range, instead of holding out for unrealistically high scores that may never come this cycle. The third and final indicator that many traders rely on is net unrealized profit loss, or NUPL. This metric shows how much profit or loss the market is holding overall. It compares unrealized gains and losses to Bitcoin's total market cap. Based on this, it tells us if the market is in phases like capitulation, hope, optimism, belief, or euphoria. Historically, NUPL has done a pretty good job at signaling cycle tops and bottoms. In previous cycles, when we entered the deep red zone of euphoria, it often lined up with major market tops, while the green capitulation areas marked strong bottoms. Currently, we're sitting in the optimism and belief zones, suggesting we're somewhere mid-cycle with more room to go before we hit peak greed. That said, while NUPL is a useful sentiment gauge, it shouldn't be used alone. It's always best to combine it with other indicators like funding rates, open interest, or on-chain flows for better confirmation before making big market decisions. You can also check out my previous video on the best indicators for this cycle, which I'll link at the end. So putting all of this together, it looks like we're still in a healthy mid-cycle phase with plenty of signals suggesting there's more room left in this bull run. But at the same time, some short-term caution is warranted given the recent exhaustion signs and key resistance levels overhead. The smartest approach right now is to remain flexible, keep taking profits on pumps, and use dips to rotate back into strong plays with clear momentum. Remember, no single indicator will ever tell you the full story. Always build your own thesis by combining multiple data points before making big moves. Let me know your thoughts in the comments below. Do you think we're still early in this cycle, or is the top closer than most expect? If you found this breakdown helpful, smash that like button to support the channel and subscribe so you never miss these grounded, no-hype updates. Thanks for watching, and I'll see you in the next one.